Hello and welcome to our Lunchtime Stock Club. Today is Monday, January 13th, 2020. Well, Happy New Year to all of you. Grab your sandwiches. Today we're going to take a look at the market performance year to date, as well as the performance of last year, and take a look at what we might have in store for us ahead in the new year. We'll also take a look at the performance results of our Investor Advisory Service newsletter, as well as some of our top picks for 2020. That's all coming up. So stay tuned to our Lunchtime Stock Club for January 2020. If you're new to our webinars, here are a few tips that will help you resolve any issues and make sure you've got a smooth presentation on your end. Make sure that your speakers or headphones are plugged in. You should be able to hear me now. Check the volume on those devices if they're not working. And the GoToWebinar application will have some sound setting wizards that can help you diagnose problems that you might have with your audio drivers or your audio devices, your speakers, your headphones, etc. If during the presentation your graphics or audio drop in or out, we always recommend that you turn off any unnecessary programs that might be running on your computer, because those can interfere with the delivery of the video and audio. If at all possible, don't connect to the internet using Wi-Fi, and remember that you can always listen using the telephone. If your connection deteriorates greatly and you can't hear the audio, call in using the telephone credentials in the GoToWebinar invitation, and that will free up your computer to deliver the graphics portion. As always, if you need assistance, please contact GoToWebinar directly at their website, gotowebinar.com, or at the toll-free number. They are standing by and can help you resolve issues pretty quickly if you have them. So don't sit around if you're experiencing difficulty. The questions box in the GoToWebinar tool is where you can type in your questions at any point during the presentation. You don't need a microphone, so that is available to you there. The archives and upcoming webinars are all listed on our iClub.com website if you click on the Learning tab, so do check those out. The handout is also available in the Handouts tab, so be sure to grab that. It is available to you right now as a PDF file. So grab that handout and you'll have a record of the presentation for later reference. And with that, let's get started. There's a lot I want to cover today. This is our first Lunchtime Stock Club in quite some time, so we've got plenty of catching up to do. And let's first take stock where we are in the market as of the second week of January 2020. Well, let's look back at the market performance of 2019. And as you can see, the blue line on top is the S&P 500 index, up almost 29%, 28.7% or so for the entire year. So that was a terrific year for primarily large cap domestic stocks. The red line is the Europe, Australasia, Far East index, Far East Asia index, and that is also available. So you can see the red line also had a great year, up 19.5%, and the S&P Small Cap 600, which we track to follow the progress of the small cap performance, is up 20.3% for the entire year. So that seems like a pretty good market segment performance all the way around. But if you step back and look at the performance of 2018 through 2019, you can see that the market was down quite a bit. In the center of the screen there, by year-end 2000, the S&P 500, the small cap 600, and the EFA index were all down considerably. So the two-year total percentage gain for the S&P 500 is about 17.9%. The small cap market up 6.5%, and the EFA down a total of 4% over 2 years. So not been a good period for stocks outside the US. This is one of the reasons why in a retirement portfolio, for instance, a 401k, or an IRA, that some broad diversification across these three indexes can offset underperformance in any particular area and capture the outperformance when those markets do perform and provide a little less volatility in your portfolio. But if you break it down, an 18% return over 2 years is really close to, a 9%, 10% return per year for the broader market, which is our overall average. So we've had one bad year, one good year, a great year, averaging out to 2 average years over the last couple of years. And that's just a way of pointing out that when we have periods of outperformance, we're likely to see underperformance ahead, and vice versa with the market. If we keep our focus on the long term and not worry so much about the short-term gyrations and the year-to-year performance, we can remain focused on what really matters in our portfolios, which is not how we did in a particular calendar year or other period, but how we've done over the period that our funds need to be at work for us to meet our financial goals. Year to date, in the first 2 weeks of the year, the S&P 500 up 0.6%, while the EFA and the small cap 600 down greater than or equal to about 0.7%. Not the big start of the year that many investors had been hoping for. The year ended on a pretty positive note, and so I think a lot of investors breathed a sigh of relief. And coming into 2020, still a little more cautious after such a great year in 2019. So the year is off to a pretty inauspicious start, and that is not unexpected. Often we like to see a little bit of a bump up in the beginning of January. We've still got a couple of weeks left to see how the beginning part of the year works out. When we look at the S&P 500 PE ratio, now this is estimated using trailing 12 months earnings as of the second week of January, going back 52 weeks, you can see that we are at a pretty elevated level. We're actually that level 24.56. That PE is higher than any PE since the recovery from the 2007-2008 bear market, when PEs jumped through the roof and then collapsed, and so on their way down to those lows below 15 that we saw in 2011, 2012, the PE reached those levels, but otherwise, even in the last couple of years, the PE has not been as high as it is presently on an estimated basis. Now, currently, on a trailing basis, the actual PE is somewhere around 19, and so again, that is elevated on that basis as well. The red line indicates this particular level. If we look back in history, you can see that these PEs have been, that this level of a PE ratio for the broader market is very high indeed. So we remain cautious. We remain concerned about the valuation of the market. It just means that we need to select our individual equities with a little bit more concern in order to make sure that we can achieve the performance that we are looking for. Now, the reason the market, one of the key reasons the market has been doing so well is that earnings have been steadily increasing, and you can see by this graph that presently the S&P 500's earnings on a trailing 12-month estimated basis are at an all-time high. And so that certainly bodes well for US stocks and US business in general, with all of the pockets of underperformance and worrisome areas of concern in the economy, in global trade, etc. There's still plenty of strength that feeds the bull thesis, and just enough on the downside to feed the bears with the kind of negative indicators that they like to see. So things remain a little bit mixed, but with the interest rates remaining at an all-time low and bond yields practically non-existent, that is keeping people in the stock market, and that's a trend that's going to take a long time to kind of shake out, and that will be responsible for, in my view, a good portion of the increased earnings and valuation the PE ratio and the valuation of American equities. So let's look ahead at 2020, and I pulled in some commentary from a couple of different sources, so looking at where are the leading market strategists and thinking, what are they thinking about 2020? Where do they think the market is going to go from here? Where are areas of concern? Where are areas of focus? Barron's every year does some great coverage on the outlook for the coming year, where they interview some lead market strategists. Their roundtable that they conduct over a couple of issues in early January is also a great source of intelligence about where the market is heading. This is their 2020 outlook from December, where they interviewed 10 market strategists to figure out their outlook for 2020. The big caveat is, of course, election year shenanigans and how the market will respond to what goes on in the elections. And also US-China trade remains a big concern. Things have been improving recently, but there still are all sorts of potential hazards along the way. And reports have been appearing in the last couple of weeks pointing out that the cost to American consumers of a lot of this trade, the trade tariffs and trade limitations have been pretty expensive. So it seems like American consumers are ending up paying the penalty, not the foreign producers. So this is definitely a concern. The 10 market strategists that Barron's interviewed are looking for a 4% gain for 2020 in the S&P 500. So that is pretty light, but again, coming off of a down year and a phenomenally up year, a little more middling year would not be unexpected. This is based on PE ratio of around 19, which is pretty close to where the market ended 2019. So they're not forecasting an expansion of the multiple in any way. Analysts tend to be considering that the levels are not going to fall off. And again, Joe's asking, are there concerns that earnings are growing while revenues are flat? And that could be definitely a consideration as well. But again, there's a lot that could be done in the area of trade that might help boost American company revenues going forward. During economic, just a side note to address Joe's question, during economic downturns, we tend to see efficiency improve. So if we do have a recession, one of the few up benefits of recession is that companies reconfigure, they become more efficient. By laying off, by downsizing, by right sizing, they become more efficient, and profit margins can increase with that focus on efficiency. Whereas during an expansion mode of the economy, where you're just running as fast as you can to keep up with orders and you're expanding as much as is possible, you end up taking on a lot of resources that aren't as effective. So I think right now we've been in a long period of where companies are preparing for recessions in a lot of ways. They're thinking defensively. They're not overexpanding. They've had a lot of time where they've had access to cheap capital. So at this point, if they haven't been borrowing money, or the money that they borrowed may have sort of tapped out what they think they can effectively control and utilize in terms of their capital needs. They're not going to be borrowing anymore. So again, on a case-by-case basis, I haven't seen as many companies in the last 6 months that seem to be working aggressively at margin expansion. So I think a lot of the excess might have been wrung out at this point. And I think that kind of bears repeating when we look at estimates of GDP growth. This is an area of concern where we see the GDP growth in 2018 was 2.9%. The estimated for 2019 is 2.3%. Barron's analysts and strategists were projecting GDP growth of 1.9%. That's a key economic indicator. If we see that, continuing to decline, that is not a good sign for the overall health of the economy. And again, consumers seem to be buying. Consumer confidence seems to be good, but there are some areas of concern there. Treasury yields in the eyes of the Barron's analysts appear to be remaining pretty flat where they are right now. So that level is much lower than it was in 2018. And I think if you had asked a lot of the analysts and strategists 5 years ago where they thought yields would be by now, they would have had an expectation of some much better, much higher yields on the treasuries than we're seeing right now. The top sectors that the analysts pointed to, some themes emerged. One is financials, currently out of favor, many financial stocks, but analysts looking at above average shareholder yield in terms of dividends and buybacks that you can get from financial companies. And there's not a whole lot of election related risk in the eyes of the strategists that Barron's talked to. Part of that just has to do with other areas where more regulation and more focus seems to be coming rather than financial stocks. We've had our regulation and deregulation and re-regulation, some big shifts since 2007, 2008, since the financial crisis. Before that, the dot-com NASDAQ crash, the end of the 2000s or the 1990s bull market. So there's been plenty of regulation, so it doesn't seem like there's a lot of risk from that perspective. I have constantly am running up against regional bank stocks that appear to be smaller regional bank stocks that appear to be performing and have the prospects of performing quite well. We cover a couple of them, South State Bank and PPAC Financial and Columbia Savings Bank in our small cap informer. These smaller banks are the ones that are running efficiently with such low interest rates, which means their net interest margins are just are stable. They're running very efficiently. So a little bit of rate increases will go a long way towards expanding their profitability and expanding those net interest margins. So it's a little bit of a waiting game. But in the meantime, they're throwing off cash, they're paying dividends. And so I would continue to look for those in the financials as opposed to the larger national banks, which are turning out profits, but they're largely driven, in my view, by fees as opposed to the business of banking. And so I think that's a little problematic. But that's what Barron's says. Barron's favors healthcare as well. The demographics favor this particular sector. And analysts see that this has more election-related risk. The talk of Medicare for all, drug pricing legislation could impact this sector. But these are not unknown. I mean, there's some unknowns about them, but everyone knows that the risk exists if you're investing in these in the healthcare sector. So I think the analysts agree that the risk is already priced into the current valuations. So we could see some modest multiple expansion as long as these industries continue to perform. In the industrial sector, the trade wars have pushed down prices, and some manufacturing indicators have begun to improve. Still a pretty mixed bag in terms of many machinery stocks, but there could be some potential there, especially as some further clarity emerges on the global trade front for some upside in industrial stocks. The top risk areas for 2020 is that headlines on trade, economy, or election fronts all threaten to drive a reactive market higher or lower for extended periods. And that's pretty much a given at any point in time, but we've constantly, business news is filled with headlines about global trade, about where the economy is and what's going on in the election. So again, that might be cause of a mini correction at some point in 2020. Our earnings growth does not appear to be as high in 2020 looking ahead. That could pull down valuations for some companies. And the consensus was the odds of a correction in 2020 are pretty meaningful. We've had other corrections that have been largely forgotten in the last 5 years. We've had a major correction, and the investors have stepped in and bought on the dip, and that's been a consistent theme. So even if we do have a correction, that I would not see that as an unhealthy sign, just the market taking a breather, some investors stepping away, letting some equities return to some more favorable valuations, and then redeploying their assets. Schwab published their 2020 market outlook, and they have separate outlooks for US stocks as well as the global economy. Their key takeaways were that the US economy will likely remain split, and I think that's a good characterization of the economy. Manufacturing and business investment seems to struggle with all the trade uncertainty, while at the same time, services and consumer spending are healthy and growing and expanding. And that's this bifurcation of the economy that in some ways you could probably argue that the way that we measure the growth and expansion of our economy today doesn't fully reflect how our nation's industries operate. The moving focus to services away from manufacturing. That transition still is underway, I think. And so I think this is pointing out that there's still some indications that everything is not as rosy as it would appear. From my perspective, that's a little healthy. If everything was all going great, I would think that that's a sign that something's going to fall apart sooner or rather than later. But with manufacturing and investment kind of off the wayside, services and consumer spending doing well, when all those start to turn south, then we are going to be in a problem. Schwab points out that the U.S.-China trade war is a concern, and if we could get some clear reversals and better agreements in place, that could really help with a lot of the resolving the uncertainty and giving some confidence back to some of these particular sectors. Schwab looks to the chance of a global recession if the slowdown in manufacturing spreads to jobs and then to consumer spending, and then we would have a pretty massive downturn. Already in China, they're feeling the effects of some economic slowdowns from the evidence that we're able to see. In 2019, the Fed, of course, reduced interest rates. That supports stock prices, again, because it just makes stocks more attractive than fixed income, bonds, treasuries, and other rate-sensitive areas of the economy. But Schwab points out that rate cuts are only a partial cure for what ails manufacturing and, quote, corporate animal spirits, which is a seemingly frivolous way of, lighthearted way of referring to the mood of corporate spending in the U.S. I like it. I appreciate it. I think the understanding is that rate cuts are not the way to direct an economic policy, and I think the market is ready for rates to kind of go back up. Free capital is not or low-cost capital has pretty much been utilized where it can do the most good at this point. That's my take on it. This is an interesting graph that speaks to the growth of equities versus corporate profitability. So this is going back to 1989 through 2019. The blue shaded lines are the areas of recession. The blue line is the S&P 500 index, and the gold yellow line is corporate after-tax profits, and that's adjusted according to inventories and capital consumption of the companies there. But you can see that stock prices have risen you know, in general, we would see periods where stock prices would go up. Let me grab my pencil and I'll just make a couple of marks. So here in the 90s, we saw a great big bubble as stock prices went up faster, much faster than corporate profits. Just everyone was very excited about equities. And then we had a retrenchment falling back. And then we've seen another divergence happening since the market recovered from the bear market and the recession of the 2007-8-9 period, and then starting in 2013, once equities kind of caught back up to profitability, equities continued to grow and profitability maintained that much more subdued growth rate. You know, it's very difficult to look at this particular graph and not say at some point, what's the likely outcome? Profitability does not look like it's going to increase this year. And so at some point, we would see some settling down of those equity valuations. It could happen very quickly. It might happen a little more slowly over the course of a couple of years, but it just doesn't seem like profits are going to be able to grow fast enough to keep up with the overall valuation of the markets. In a perfect world, perhaps, you know, the market would plateau for a period of time, but the market never seems to do that. The market never reacts rationally and says, all right, you know, there's no point in jumping out of the market now. Future returns might be a little subdued. We're just going to sit here and wait for profitability to catch back up. That seems to never happen. Investors don't think that way. They don't think rationally. They say, well, if the economy really is turning down and earnings are falling, then let's just get out of the market and go find something else to invest in. And the big problem of the last decade is where to go to invest. But at some point, something's got to happen, right? It's pretty inevitable. I think when you look at a graph like this, we've had those corrections in the past couple of years, 2018, you can see that little drop off. But we're going to continue to see the market and the corporate profits continue to be on divergent paths until we've got some sort of catalyst, I think, that will drive them closer together. The key takeaways of Schwab's outlook is that high debt and weaker profitability will continue to pressure small company stocks a little more than high company stocks. But overall, they believe that quality companies with strong balance sheets, low debt, consistent earnings, and reasonable valuations will be the best performers. That those are the key concerns. And that's an interesting takeaway, right? Because our whole approach in the better investing universe is that quality companies that have consistent earnings when purchased at reasonable prices are the key to long-term success. And so their key takeaway is you got to focus on the fundamentals, and that is always true. And then finally, JP Morgan had published their outlook. So this is their global research department, and they're looking for higher growth outside of the US and lower returns for 2020. They are seeing even slower GDP outlook than the analysts that Barrons interviewed. They're projecting 1.7% GDP growth compared to about 1.9% from the Barrons outlook. But global growth at 2.5%, and EM, the emerging markets, growing at 4.2%. So from a global perspective, JP Morgan for 2020 seems to believe there are more opportunities in the emerging markets for some outsized returns in the coming 12 months. Their other key takeaways, their 2020 price target of the S&P 500 is 3,400 based on earnings of 180 and a PE of around 19. So they're expecting, again, no more expansion of the multiple of the market, but moderate earnings growth, taking the S&P 500 up nominally for the year. But they do expect another repeat of 2013's great rotation, where retail investors will continue to move away from bond funds into equity funds. And that again will support equity prices if that trend does actually happen. They project 2-year and 10-year Treasury yields ending 2020 at 1.6 and 2.05%. Again, and that just doesn't excite hardly anybody in the market, and barely keeping pace with the rate of inflation. So that's just some food for thought as we look ahead at 2020. My closing, I've been talking about bear markets and recessions pretty constantly in the last decade, and my takeaway is that if we do have a bear market, if we do have a correction, if we do have a recession, then it's going to be too late by the time those things happen for you to take action within your portfolio. Then you're reacting instead of being proactive. And so I think you should always be incorporating defensive thinking in your portfolio construction. Healthcare is a defensive area to be in, so you might want to look at that particular area in light of some of the strategist perspectives for 2020. Park asks about thoughts on technology, and technology was not a theme that appeared very much at all in any of the outlook that I saw. Certainly business investment, which would include investing in companies, pre-IPO businesses, and mergers, acquisitions, and a lot of that happens in the technology space, seems to be subdued. We've seen IPOs being shelved in 2019 for lack of interest, perhaps, or because the market just was not responding as well to those companies going public. And I see perhaps that trend continuing a little bit into 2020. Technology, again, just all over the map from my perspective. I'm just thinking that our technology exposure in our small cap Informer newsletter is pretty low at present. I think that is largely driven by global trade issues that making some of those companies struggle, either because they have huge markets in Asia and outside the US that they can't service as well, or that they have been dependent on parts that had been manufactured outside the US, so that's causing some difficulty for those businesses. So I think those technology headwinds are going to continue to stifle a lot of business in that area, in the technology sector. I wanted to update on the Investor Advisory Service. The Investor Advisory Service is our stock newsletter published since 1973, and it has been continuing to perform well, and we're very pleased that it was named to the Hobart Financial Honor Roll in 2019 for the 10th consecutive year. So that's 10 years in a row that our newsletter has been pegged as one of the top performing newsletters for consistent performance in the market. Now, the honor roll that Hobart puts together, and now he has a website at hobartratings.com where he continues to track the performance of stock newsletters. And in his estimation, the newsletters have to outperform each bull and bear market cycle over the long term. So typically he goes back 6 market cycles in time. His finding is that the honor roll recipients tend to be more consistent performers than the newsletters that are the outright winners that have the highest rates of return in single year periods. The honor roll newsletters, like the Investor Advisory Service, go up more than the market in bull markets and go down less than the market in bear markets. So even though we are on the honor roll, we expect that if we have a bear market, our picks will decline, but not as much as the overall market. And then on average, newsletters like ours outperform newsletters that are not on the honor roll, and that's happened every year since the mid 1990s. So we're very pleased with that. Here's a little graph of our long-term performance of the 10, 15, and 20 years as of November 30th. In green is the Investor Advisory Service. Our 10-year return compared to the S&P 500, about 0.5% higher. But as we get into 15 and 20 years, you can see our performance really begins to outshine the broader market. The yellow is the Wilshire 5000, the blue, the light blue is the S&P 500. In the short term, our performance tends to be variable, which is fine with us. We don't sweat it if we're not beating the market over the last 12 months or in the last calendar year, because again, our focus is on longer term returns. So the proof is in the pudding, as they say, and this is the Hobart take on our performance, his validated figures there. So we're very pleased with that. If you are not a subscriber and you want to take advantage of a special celebratory offer, you can use the promo code 10 for 10 to celebrate our 10th year out of 10 being named to the Hobart Investment Newsletter Honor Roll. That's something that only 1 or 2 other newsletters can boast out of the 10 or 12 that are on the 2019 Honor Roll. There's only a 1 or 2 that have been on it as long as the Investor Advisory Service. So we're very pleased with that, those results, and wanted to share that with you. Once again, the Better Investing has joined with the Money Show to present a Top Picks Report for 2020. Every year, Money Show interviews 50 or so of their participating newsletter editors and financial advisors and come up with their 100 plus investment ideas covering the best stock and ETFs for 2020. So this report, which I will give you the URL for in just a moment, is available to you free. You can check it out, and you can get a copy of it for your personal use. It's got everything from conservative blue chip stocks, it's got high growth tech stocks, it's got ETFs and funds that meet all sorts of different criteria. And it does include picks from the Small Cap Informer and the Investor Advisory Service. And I'm gonna give you our selections as well. But in the meantime, you can download it. You may have gotten an email if you're a Small Cap Informer or IAS subscriber today, but you can download a copy from, I just pasted in the chat the URL that you could click on and download it from the website. You'll need to sign up with your name and your email address to get a copy of it, but it's a pretty comprehensive document. So we're glad, once again, last year in 2019, our Investor Advisory Service picks were Air Lease and Cummins. Air Lease was up 60% for the year, and Cummins was up in excess of 30% for the entire year. So those picks worked out very well for the 2019 Top Picks Report. The year before, we had also had one of our picks in the top 5, I believe. So we're pleased that our participation is noted in the report. You'll see some of our past winners that we've selected, that our approach stands up with the other analysts there. So please feel free to grab a copy of that, and if you can't get that URL to work or the link to work, just send me a message after the presentation, and I'll send you I'll send you the URL directly. So to close out, let's talk about a couple of the stocks that we selected to focus on for the 2020 Money Show Top Stocks report. From the Investor Advisory Service, our picks were Spirit Airlines and Insperity. These are 2 stocks that were covered fairly recently. Spirit Airlines, again, if you believe that a global recession is coming, then an airline is probably not the right place to be putting your money. But there's a lot of positive things to say about Spirit Airlines. This is an ultra low cost carrier. They get a bad rap from some pundits and some travelers because as an ultra discount airliner, they charge for all sorts of things. You get a seat, and then beyond that, if you want baggage, if you want to change your fares, if you want heavier bags, if you want carry-ons, there are all sorts of additional fees. But for people who are very price conscious and who understand how these operations work, they have been they are one of the most loyal sets of customers, people who just want to travel and do it on a low cost basis. You can see the revenue growth there has been very strong. Earnings a little choppier, but the balance sheet is pretty strong. And their fleet is much younger because it's a newer airline, so their planes are not as old, so they are require much less maintenance and serve the airline pretty well going forward. So that is our take on Spirit Airlines. Could reach a high price of 105 in 5 years. And a low price of 27. So at the end of December, that was a 5.7 to 1 upside downside ratio. Insperity is a company that focuses on employee benefits and outsourcing services to companies to manage their employee benefits and solutions, what's known as a professional employer organization. So $4 billion in sales. So again, sales growth has been pretty strong. Earnings and profits, as you can see, have risen pretty nicely. They work with typically smaller companies. About 3/4 of its sales come from businesses with less than 100 employees. So these companies don't want to have a huge human resources staff. Maybe they got one person managing payroll internally and resources, so they can offload that work to Insperity. And so it's working pretty well. They can negotiate for workers' comp insurance and healthcare benefits as well. And these policies are very attractive to Insperity's customers. So this is a very interesting kind of business, but again, as the economy moves away from manufacturing into service organizations, I think this is a great example of that move of the economy where companies can take advantage of services that allow them to focus on running their business and then have the additional stuff be handled by an outside source. Companies have been doing this with payroll for years with companies like ADP and Paychex. So this is the next level, taking some of that other workload off your administrative staff and offloading it to a company. So Insperity appears to have a pretty good future looking ahead. For the small cap informer, we focused on a couple of our recent picks. One is NV5 Global, which is a consulting and engineering firm. We began to cover them a few years ago, and they performed very well for us. You can see on the graph that the last couple of quarters earnings have fallen off a little bit, but seems that recovery is imminent. And I believe that a lot of the sell-off is creating an opportunity to buy shares at a pretty depressed prices. They had some delays in an LNG, a liquefied natural gas conversion project, and some declining revenue from contracts with North Carolina, and as the state temporarily couldn't get a budget passed, and so they delayed spending. And again, so when you delay the spending, it means the revenue is going to come in at a later date. Those contracts should be fulfilled as soon as the legislator reopens the funding lines, as we expect that they will. So There's certainly the thesis behind NV5 Global. They handle a lot of municipal and government clients, as well as airports, school systems. They work for Duke Energy, Caltrans, and so there is a lot of infrastructure work that needs to be done in the U.S. Bridges, everyone knows bridges, tunnels, etc., and that is certainly an area of growth for this particular company. NV5 has also been expanding by making some acquisitions, but they just don't like to carry the debt for very long. So they, the debt to equity will jump up when they make an acquisition, and then they pay it off very rapidly to get their balance sheet back in order. So current debt to equity is just 10.7%. So they've integrated a bunch of their recent acquisitions and paid them off. So I like the prospects for this company. I think it's a little contrarian at this point. And then our other pick is Preferred Apartment Communities on the right. This is a REIT, Real Estate Investment Trust, not necessarily appropriate for an investment club, a little more complicated on the bookkeeping side, but something to look at for your personal portfolio. As the name implies, this is a REIT that focuses on residential units, but they also have office buildings, in addition to the multifamily properties, and retail properties. So they are a little diversified. The reason that for the diversification is, or the benefit, we'll say the benefit of the diversification is that residential REITs tend to be very cyclical. If we have a downturn, they might experience higher rates of occupancy occupancy would go down during REITs. That might affect their earnings and the funds from operations there they earn. But the retail that Preferred Apartment Communities owns tends to be in grocery anchored markets, and grocery stores are anti-cyclical. Grocery stores continue to perform during recessions. So there's some thinking that your grocery store plaza might be in a little better shape than some other retail plazas. You won't have to worry so much about key tenants pulling out. The grocery stores will continue to operate. So it provides a little bit of diversity there, but certainly if we do have a recession, I would expect a little bit of a downturn for Preferred Apartment Communities. They do have a student housing business, but they've been getting out of it. They found that it's too seasonal. And again, student housing for universities, where they would operate apartments, off-campus apartments for student housing. And the problem with those is that they go empty during the summer. Occupancy falls off during the summer, and so instead of getting that year-round stream, you're getting it only 9 months out of the year, or 9 or 10 months out of the year. So they've been getting slowly divesting those businesses. They still have one major property that they are operating. They just couldn't find a buyer for it at the price that they wanted to sell it for, and they decided that it would be better to make some improvements on that property and raise the perceived value, and then unload it in the marketplace. So that is happening as well. The total same store, same unit occupancy is about 95.6%, so that's very high, and that's just a good sign that they're keeping their units occupied, that when units go vacant, they can turn them around pretty quickly, and are not experiencing problems in the market. So, but we do, and finally, there's another issue, a little more complicated, is their mezzanine loan business, which is a little lumpy. They were making some real estate loans out of their portfolio as well, for which they would be repaid. And in the past, those were pretty irregular. Those loans were not necessarily scheduled on a particular for payments on a particular schedule. The market did not like this particular part of the business. The company maintains that it's highly profitable, and they have had good success doing it. So they've sort of helped that mezzanine loan business to mature a little bit. So they've got some longer duration there and some more regular payments. So they've got a better handle on the cash flow portion of the business. So, again, there's this stuff a little more complicated, and I think some investors shied away from it. It's not as straightforward as some others, but I think that over the long term, that performance that you see on the right will continue and will drive results there. So in the REIT section, that's one that had been popping up on my radar for some time. So I think this could be a good year for preferred apartment communities. So if you have any final questions, please enter them now. Here is, boy, this is my 2020 schedule as of today, as far as I can remember, but we've got money shows in Orlando and Seattle, and then in San Francisco that we'll be doing. The Better Investing National Convention is in Dallas in May. The AAI National Conference is in Las Vegas in October, and I'll be at Better Investing chapter events in San Diego, Fort Lauderdale, Cleveland, Central Pennsylvania, and Philadelphia. So I expect to have some more scheduled as we go ahead, but that's a pretty busy year for the conferences and events that I put on. Jay asks, what's my analysis of LKQ for 2020? I don't follow that. I know we track it in the Investor Advisory Service, but I don't follow it personally, so I don't really have an opinion for it. Again, my outlook for LKQ over the long term is pretty strong when you can buy it at a reasonable valuation, that the business model is strong, that they have quickly become, or over the decades, have become the go-to for many repair shops looking for remanufactured and used parts for automobile repairs. And so I think that's always going to be a pretty compelling business. I think some of their global expansion is kind of interesting as well. We'll see how that works out. But beyond that, I don't have any particular opinion about that particular company. All right, with that, I'll say thank you. Thanks for coming to our inaugural Lunchtime Stock Club for 2020. We'll look forward to seeing you at a future Lunchtime Stock Club meetup. And as always, I'm wishing you the best for a happy and healthy 2020 and the same for your portfolios. Thanks again. We'll see you next time.